You know that economic slowdown we're all feeling? What if it isn't just some temporary dip? Well, economist Peter Schiff has a far more alarming theory. He's saying the US has skipped a recession entirely and plunged straight into an actual depression. So today we're going to break down his pretty controversial claim.
Okay, so let's dig into this. This one statement from back in April 2023, it's pretty provocative, right? It's really the foundation of his entire argument. Now, it's designed to be shocking, for sure, but he claims the evidence backs it up. So to really get what he's saying, we first need to understand the words he's using.
See, it all boils down to definitions. A recession, that's usually a short, sharp shock. A couple of bad quarters and then things bounce back. But a depression? Whoa, that's a whole different beast. We're talking about a long, grinding economic winter that can last for years. So Schiff's whole point is that the pain we're seeing isn't just a temporary blip. He thinks it's a deep, structural problem that's here to stay for a while.
All right, so let's jump into his first major point. He starts by taking a sledgehammer to one of the most positive economic numbers we hear about all the time, the job numbers.
So, you've probably seen the headlines, right? The government comes out and announces this huge number, over 500,000 new jobs created. And on the surface, that looks fantastic. It suggests a really robust, healthy economy. It's the kind of news that makes everyone breathe a sigh of relief.
But according to Schiff, that big, shiny headline number, it's totally misleading. He argues we need to stop looking at how many jobs are being created and start asking what kind of jobs they are. And when you do that, a very, very different picture starts to emerge.
Okay, so this slide really gets to the heart of a key distinction for Schiff. He argues that a truly healthy economy is built on private sector jobs, companies making things, providing services, and paying taxes. But he claims a lot of these new jobs are actually government roles, which don't really produce economic output but are funded by our taxes. In his view, it's kind of like hiring more people to spend money, not to earn it. And it's not just who is doing the hiring, it's also about the quality of the jobs being created, even in the private sector. He points out that all those high-paying, high-skilled tech jobs that we saw disappear in recent layoffs, well, they aren't being replaced by similar roles. Instead, the real growth is in lower-wage service sectors, like hotels and restaurants.
And this is where the rubber meets the road, right? This shows you the real-world impact on people. You've got these highly skilled professionals, engineers, project managers, who are now seriously underemployed. They're being forced to string together 2, maybe 3 lower-paying jobs just to try and match their old salary. So while the number of jobs is technically going up, the actual economic well-being of the workforce is going down. Okay, so let's build on that idea, because now we get to what Schiff sees as the real threat, something way bigger than the job market. He believes the central danger is to the stability of the US dollar itself.
He describes this fundamental imbalance in the global economy. Basically, the US buys trillions of dollars worth of stuff from other countries, but it doesn't produce and sell nearly enough to pay for it all. So how does it make up the difference? By creating more dollars out of thin air. And for decades, the rest of the world has been willing to just accept these dollars in exchange for real good.
And this leads us to the absolute crucial point of his argument. This whole system, this whole loop, it only works as long as other countries are happy to take our dollars and hold on to them. But what happens if they stop wanting them? What if they decide they'd rather have something else? Schiff argues this is already starting to happen, and if the demand for dollars craters, the US suddenly loses its ability to buy all the things it needs from the rest of the world.
And yeah, Schiff does not mince words here. He's predicting a financial crisis that he thinks will make the 2008 mortgage crisis look like a walk in the park. We're talking about a potential collapse of the dollar, a massive public debt crisis, and runaway hyperinflation as the value of our currency just plummets.
So, how does all of this connect to the banking system? We've already seen some major banks looking pretty shaky. And Schiff argues that the government's response is actually just making the underlying problem a whole lot worse.
He lays out what he calls a bailout inflation cycle. It's a vicious circle. Here's how it works. It starts when a huge bank gets into trouble. To stop a system-wide panic, the government steps in with a bailout. But where does that bailout money come from? Well, it's brand new money, printed just for this. This massive injection of cash then devalues every other dollar that's already out there, which leads directly to severe inflation. And this is how it hits you, right in your wallet. The number you see in your bank account, it stays the same. But what that money can actually buy, it just plummets. Your money is worth less. That's why suddenly you can afford less food, less gas, less of everything, even though your balance hasn't changed. Your savings are literally being eaten away by inflation.
Okay, so after painting this, let's be honest, incredibly bleak picture of jobs, the dollar, and the banks, does Schiff offer any way out of this quagmire, as he calls it? He does, and his proposed solution is just as controversial as his diagnosis.
His whole prescription is basically to radically shrink the role of government. He's calling for immediate and drastic cuts to spending and regulations across the board. The goal here is to free up the private sector, what he calls the engine of growth, to start producing again, creating real value, and pulling the economy out of this mess. So, what's the big takeaway here? Look, Peter Schiff's analysis it's intense. It's an incredibly stark diagnosis with a really radical cure. Now, whether you agree with them or not, his argument forces us to look past the headlines and ask some really tough questions about the long-term health of the economy. And it leaves us with one final thought. Is this some unavoidable future he's forecasting, or is it a warning we should all probably heed?